All right, let's dive in and decode the rulebook for money in Uganda, the Income Tax Act. Now, whether you're an individual, you're running a business, or you own some property, trust me, this law affects you. We're going to cut right through all the legal jargon and get to the core principles you absolutely need to know.
So what's the big question we're trying to answer here? Well, it really just boils down to this. What are the fundamental rules of Uganda's tax system? By the end of this, you're going to have a really solid grasp of the who, the what, and the how much when it comes to income tax in the country.
You know, with just about any complex law, there's usually one simple idea right at its heart. And for Uganda's Income Tax Act, it all kicks off with one foundational principle that really sets everything else in motion. This right here, this quote from Section 4 of the Act, this is the trigger. It basically says that a tax gets charged to every person who has chargeable income. That's it. That's the starting line. So that tells us we need to understand two key things. First, what does the law mean by a person? And second, what on earth is chargeable income? Let's tackle that first one. Okay, so who exactly is a person in the eyes of the taxman? You might be surprised. The answer is a whole lot broader than you probably think. Yeah, when the law says person, it's not just talking about you and me. It's pretty much any entity that can earn an income. We're talking partnerships, companies, retirement funds, even the government itself. It's an incredibly wide net. And this really drives the point home, right? When the law says person, it means you, it means me, but it also means a partnership of lawyers, a family trust, a massive corporation, a pension fund, and yep, even government bodies themselves. This whole concept is just fundamental to how the entire tax system is built. Okay, so we've got the who. Now let's talk about the what. What actually gets taxed? This is a really common point of confusion, especially when it comes to rental income. The Act is super clear about this distinction. So look at this. The law basically draws a line in the sand. On one side, you've got your general income tax. That's things like your salary or business profits. But on the other side, you have rental tax. And the Act is really explicit here. This is a separate tax. That means your rental income is totally ring-fenced and taxed completely on its own. All right, so we know who pays and what they pay on. That leads us to the big question, right? How much do you actually have to pay? And this is where it gets interesting because the rates are totally different depending on what kind of taxpayer you are. So check this out. For you and me, for individuals, it's a progressive system. The more you earn, the higher the percentage of tax you pay. It climbs from 10% all the way up to 40%. But for companies, trusts, and retirement funds, it's just a single flat rate. A small startup pays the exact same tax rate on its profits as a massive corporation. And that flat rate is 30%. Yep, 30%. If you're running a company in Uganda or even just thinking about it, that number is one of the most important ones to burn into your memory. Now, what about that separate rental tax we talked about? Well, it has its own special rate for individuals. The rule is 12%, but, and this is important, it only kicks in on rental income that's above that threshold of 2,820,000 shillings per year. So it's another clear, specific rule designed just for property income. We're almost there. We have one last piece of the puzzle, and honestly, it's a big one. This distinction between being a resident and a non-resident is absolutely critical because it determines how your income from all over the world is treated. So, how does the law decide which one you are? Well, Section 9 of the Act makes it surprisingly simple. It's a three-part test, and here's the kicker. You only need to meet one of these conditions to be a resident. So test one. Do you have a permanent home in Uganda? If yes, boom, you're a resident. If not, we go to test 2. Were you physically here for 183 days in any 12-month period? And if that's a no, there's a final test based on your average presence over 3 years. It's a really clear checklist that doesn't leave much room for doubt. So, let's just pull all that together for a second. We've seen the law cast a super wide net, defining a person as almost any entity. It carves out rental income for its own special tax. It sets progressive rates for individuals, but that flat 30% for companies. And it uses that clear 3-part test to figure out your residency. Together, these rules really are the bedrock of Uganda's tax system, which leaves us with one final thought. How does this specific framework, these rates, these definitions, these distinctions, truly shape the flow of money, business, and daily life all across the country?